So 10 to 15% of exposure in any dominant theme is what you are recommending. Uh, Leading to that is my next question. In such a scenario, is a tactical entry and exit important, for such thematic investments? And if at all they want to do, how can investors figure this out by themselves?
Well, this is like asking, give me a number for which I can buy a lottery ticket and I'm going to win the $1 million sweepstakes. It's easy to have this conversation, but it's difficult to actually time a cycle in a particular theme. Now, I'll tell you what does happen though. Everybody tries to catch a theme at the top of its game. You know why? That's when there's maximum information, maximum performance, and maximum awareness. Sadly, most people who come into, let's say, an infrastructure team or an IT team or a banking team is when the past 1 year performance is very, very good and it's better than the diversified equity funds. Now, my take on this is if you really like a theme, you buy it before the theme plays out, not after. Or you buy it whether the team is performing or not because you believe that the idea will do better than the whole market as a whole. Now, if I were to take another step forward, we need to understand that these themes that we are talking about also go through a lot of cyclicality, right? Now, today, when you look at it, let's say infrastructure is just very quiet now, and let's say IT is doing very well. There's a good chance that people will say, you know what, IT is done well, and in your mind, you're playing this mental thought process. Bank India, exporting IT, rupee dollar at 82. I think IT can never go bad. Let's put money in IT. And then you take a 20-30% knock, you lost conviction, you lost patience, you sell at a loss, and you come back to some other sector. So rather than go up and down like it's like switching lanes in your toll plaza, don't do that. Stick to what you know, stick to what you understand. It's better and safer to be in something that you're comfortable, that you understand, and also you're willing to see the drawdowns play out because you're playing for the upside. It's a story of conviction. So, summarizing that, I think thematic is not for everybody. The concept of strategic versus tactical is given on the fundamental aspect that I know when a cycle is going to play out. So I'm going to buy IT today. It's going to perform well in the next 2 years. At the peak of it, I'll remove. I wish life was that easy and simple for us to enter a sector when it's at the bottom and exit at the top. It doesn't happen. But if you invested in a particular theme, it's 2 years, 3 years, 5 years, and you saw the theme perform reasonably well compared to the index, maybe that's the time to profit book or even exit. So I would say rather than entry, it's a lot more easier to time the exit when you experience the desired outcome, which is outperforming the market and outperforming the diversified theme, right? Then you take out some money or maybe reduce your exposure or maybe trim down your exposure to the initial exposure. But I know there are people who say we'll take a tactical call. But the question is the tactical call, if doesn't play, will become a strategic call because you have to keep it for long term. So I'm sorry if I don't give you an answer that you were looking for, but this tactical and strategic is sometimes very loosely used. If it's tactical, then you need to know when to get in, when to get out, and you should also be prepared to say, "Hey, did I get in did I get out at a loss, or did I get in at the desired outcome that I came in for?"
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.